Certainly when we're thinking about the starting point for 2016, what we're seeing really is the same degree of pessimism that's been around for a while now about Australia's economic prospects. We're seeing the same debate about whether there's a risk of a recession or not occurring in Australia over the next year as well. And in many ways it's easy to understand why the debate's so focused on these sorts of issues, because we do appear to be going down this depressingly familiar path where we see downgrades to global growth forecasts, concerns about the outlook, rising concerns about how Australia fits in that. There's been plenty of financial market volatility to add to that general fear as well. Now, having dragged the mood down, I better restore my reputation as a positive economist and say up front that I think when we get to the end of 2016 and look back, we'll see an economy that we're reasonably happy with. So maybe economic growth is not going to be as strong as we would like to see, but it will be positive, and it will be a long way from those recession-type risks that people want to talk about. Unemployment probably higher than we'd like to see, but we think we'll maintain a positive rate of jobs growth as we move through this year. Now these conclusions probably sound a little bit optimistic when you benchmark them against some of those concerns that I've mentioned, some of that volatility in financial markets. But I'd also argue that what you're seeing in financial markets and that volatility is very hard to explain when you benchmark them against the economic fundamentals that should be driving these things over time. Thought I'd just start off with a couple of charts to give you a feel for what is happening right now. So the chart on the left-hand side, for example, shows you some forecasts for global growth for different years and how those forecasts have changed over time. And as you can see, there's a pretty standard pattern here, and that economists will start forecasting global growth to run about 4% a year, which is around the long-run average. Then as time passes, unfortunately, and as reality intrudes, those forecasts are more or less continually revised down. And certainly we've seen some of that same story coming through in the early part of 2016. Financial markets have been volatile. The chart on the right-hand side there shows you a couple of measures of financial market stress. So it covers all markets, global equity markets, global interest rate markets, currency markets, and so on. But basically the way to read those charts, the higher the line, the greater degree of stress in the global financial system, and certainly the readings that we're seeing right now are elevated, and in fact they're at the highest levels that we've seen in about 5 years. But such elevated levels of stress, I think, do seem out of kilter again with the economic fundamentals, with the economic factors that people point to try and explain what is going on. So if I go back to those global growth forecasts, for example, yes, they have been revised down again, but it's not because of any kind of general malaise. It's country-specific issues that are playing out here. So, of course, because of low oil prices, we have seen the growth prospects of oil-producing countries revised down. There are some big countries like Brazil that are in the genuine recession. Their forecasts have been revised down. But once you move beyond those specific examples, most of the numbers haven't changed at all. And from an Australian point of view, what's particularly important is that forecasts for that key China economy haven't been changed. So these sort of trends, I think, are certainly something to watch pretty closely, because there is a risk here that uncertainty, volatility feeds back into growth concerns and growth prospects, and then back into market volatility again, and business and consumer confidence will suffer in that environment. But equally, we should look beyond the headlines that we're fed on a daily basis. Now, when you try, as an economist, to explain what is going on here, what typically happens is people will point the finger at the US. Their central bank, the Fed, is in the process of lifting interest rates, and people worry about how far and fast they'll go on that front and what the impact will be. People point the finger at China, and of course there are concerns there about the growth slowdown that's occurred and the ability of Chinese policymakers to control their economy. But again, we need to put these things into some sort of perspective, and that's what I've tried to do on these charts. So that chart on the left-hand side, US interest rates, that little blip on the end is what everybody's excited about. We saw a 25-point rise in US interest rates at the end of last year, but US interest rates are still very close to zero. And even if we have 2 or 3 more rate rises this year, US interest rates are still going to be very, very low by any longer run stretch. Part of the issue here, I think, is that we haven't actually seen a rate rise cycle in the US since 2006, and as somebody pointed out to me the other day, back then the iPhone didn't exist, which gives you an idea of just how long ago that we've had to think about rising interest rates, and clearly a lot of players in financial markets just have no experience in that sort of environment. If we think about China and what's going on there, well, the chart on the right-hand side shows you a few indicators from Chinese financial markets. I'll just highlight one, the black line that shows you what's happening with the Chinese currency against the US dollar. Well, it's been slowly moving lower over the last couple of years. A few blips along the way, and those blips have on occasion had a big impact on global financial settings. But again, perspective, what that chart is telling you is the Chinese currency today is 8% lower than it was at the start of 2014. Over that same period, the Australian dollar dropped by 22%, and nobody really blinked an eye about that. So it does look like a big reaction to what is really only a very small move in a financial price. There are some lessons that we should take away from this, of course, and one of those is that sort of aura of invincibility about Chinese policymakers has taken a dent in the last 12 months as they've struggled to control their economy and some of the excesses that have been working through there. But more importantly, while we've all known for a long time now that China is critical in driving global economic growth, driving demand for commodities, the reality is that Chinese financial markets are now a big part of the story that we need to follow pretty closely as well. And just having had a go at the iPhone generation, I should say, in an attempt to prove to my children that I actually know what is going on, I've put this chart together here, and it shows you trending searches on Google for the words China economy, the green line on this particular chart. And you'll see over the last couple of years there's been big spikes in that as people have become concerned about what's happening in the China story. But the purple line, though, the other line on that chart, it's something called the VIX index. It's a measure of share market volatility in the US, but universally it's more or less known as the fear index. So whenever that index spikes up, it means there's a lot of fear in financial markets, and you get this big moves that we've been seeing in recent times. And you can see now just how closely that kind of measure of global fear, if you like, is correlated with concerns about the China economy. So China's important for financial markets, and because of that, important for us all as well. Now, adding to the concerns in recent times, of course, has been the large moves in some commodity prices, particularly oil. Large falls, extreme volatility coming through there, and it has added to the general fear and loathing in financial markets. And to go back to that forecasting story again, certainly there were a number of people out there a few years ago forecasting the oil price to go to $200 a barrel. It does look like it's a little bit off the mark. But the point I would make, though, is that while the gyrations of the oil price have added to this uncertainty, I haven't seen any of the debate about what some of the positives will be. And that is, while lower oil prices are bad news for oil producers, it's pretty much good news for everybody else. And just one illustration there, the chart on the left-hand side, the brown line there, that's the oil price plotted upside down. So as that line goes up, it means oil prices are falling. But what you typically see in that sort of environment is growth in the advanced economies, the ones who tend to import a lot of that oil, actually picks up. It's good news for consumers and businesses in those economies. And if you run through the list of Australia's major trading partners, most of them are oil importers, and they should be benefiting in this low oil price environment, and will receive some of the benefits of that flowing through to us as well, we think. Likewise, while there's a lot of focus on where US interest rates are going, the fact is the other big central banks in Europe and in Japan are still easing policy. We now have negative interest rates in Europe and in Japan. Those big central banks are still buying government bonds as part of their quantitative easing process, as it's called, to try and keep long-term interest rates down. In fact, when you do the calculations, which I've tried to show on the chart on the right-hand side there, those big central banks in Europe and Japan will be buying more government bonds over the next couple of years than will actually be issued. Now, it's supply and demand, just as it is with oil. And when you've got that sort of strong demand in markets, what you will see is the price of the bond will go up and the yield or the interest rate will come down. So whatever the Fed may do with short-term interest rates, it's going to be an environment where long-term interest rates remain very, very low. And for many countries, that's the more important interest rate that drives economic activity and so on. So my point here is a lot of these things that seem like negatives are in fact, or do have some positive aspect to the story, I think, when you go into the detail behind the headlines there. The one area where we do have some concerns, though, is currency markets. Now, we tend to focus on stock markets as a source of uncertainty, a threat to growth, interest rate markets likewise. Maybe this time round it's currency markets that we should be watching most closely. And I say that because after a number of decades where world trade grew very, very strongly, that's pretty much came to a halt a few years ago. And the chart here, the brown line, it shows you world trade as a share of world GDP. And you can see how it's more or less just flatlined over the last 5 or 6 years. What I think we're seeing here is a reflection that that 20-year period where we built global supply chains, global production chains, global value chains has come to an end. And that period where those chains were being built was a very expansionary one for global trade, and countries that based their growth strategies on getting into that chain, being part of it, did very well. But if that process is now complete, that source of growth for many countries, and particularly in Asia, has gone. And so growth in those countries is going to be more about the domestic side of the equation. And the policy focus, I think, in that environment shifts to, well, how do we protect that domestic source of growth? How do we contain it within our own country? And one of the ways you can is by having a lower exchange rate. So it explains why pretty much everybody wants a lower currency right now. Now that's not possible. As someone's going down, somebody else has to be going up. The threat to us is that we may be one of those currencies that goes up in that environment. But clearly it's an issue where potentially trade wars, to give it that sort of name, currency wars become an issue and a bigger threat to growth. So certainly watching currency markets and what happens there will be pretty important when you're assessing the risks. We can probably tell from what I've said so far that most of the risks that we see facing the Australian economy this year have come from offshore. But clearly there are some local issues that are still working through and that we need to pay close attention to as well. And the main ones there are the fallout from the end of the resources boom a few years ago. So we're still in an environment where commodity prices are falling, and of course we're still in an environment where that big mining construction boom is unwinding. And that's where the local risks come through. And the way they play out, you can see on this set of charts here, I think. So on the left-hand side, weak commodity prices is something that's restraining Australian income growth overall. That chart there captures everybody, so captures company profits, household incomes, government revenues. And as you can see, the last few years, we've seen very weak income growth, sort of numbers you'd normally expect to see in a recession. And the only time we've had something weaker than this was back in the early 1960s. So this is very exceptional times of what we're seeing here. And of course, one of the ways that plays out is there's a very heavy focus on cost control. So if governments can't achieve the revenue targets they need, then in a sense all they've left with to push back towards budget balance is by cutting costs with an economic impact there. Companies are reluctant to hire and invest in that sort of environment and so on. So these are where the sort of risk issues in that part of the story play out, I think. The other side, the mining construction boom, well, that did finish in 2012, and the green line there just shows you how big that mining investment boom was, and equally how far the fall is going to be from that peak back to more normal levels of spending. In fact, we think that peak to trough move in mining investment spending is going to be equivalent to about 4.5% of GDP. So it's actually bigger than the US fiscal cliff that everybody worried about a few years ago, and clearly a significant threat to the economy. Particularly when, if you look at the other line on that chart, the purple line there, it's a measure of the number of people who are involved in mining construction activity. So it's not only big falls in mining capital spending, it's big job losses that will go with the end of that boom as well as some of the domestic risks in the story. Now, we've never been particularly worried about this mining capex cliff, if I could call it that, because we thought we'd probably export our way out of this problem, and that's certainly still, I think, the most likely outcome here. And just to give you a few examples, the chart on the left-hand side here it shows you the sort of increase we're going to see in resource exports over the next few years as things like these big LNG plants actually get turned on. And that's going to be worth something like 1% of GDP for a number of years, and a very powerful offset to that downturn in mining capex that's flowing through. What's been particularly interesting, though, is that we've also successfully exported the job loss problems that's come with that downturn in mining capex. And you can see what's going on, I think, in the chart on the right-hand side there. So what we've discovered as these projects come to an end, the really highly specialised construction workers here on 457 visas, the green line, well, they've moved on to wherever the next big mining project is, and so we've exported them. It turns out that a fair proportion of these mining workers actually came from New Zealand, and so we've exported them back to New Zealand, the purple line on that chart. And of course, what's also helped, I think, is the fly-in, fly-out nature of the workforce in many of these mine sites. And the red line there shows you the dramatic slowdown in the number of passengers flying into mining-related airports on the back of this story. But what it really means is that people are losing their jobs in the Pilbara where they work, but they're actually becoming unemployed in Sydney or Melbourne or wherever they actually live. So we've exported the problem from the regional areas to the capital cities, and that's been helpful because, of course, that's where most of the new jobs are being generated. So there's a degree of luck there, it has to be said, but these issues haven't been quite as damaging to the economy as they look like on paper. Real question, of course, is whether we can keep it going. So to do that, we do still need to see a move from resource activity to a much more non-mining-led growth picture. And when I look at the drivers there, the story does become a little bit mixed. And you can see, I think, what's going on in this particular chart here. So we hope that transition towards the non-mining economy will be driven by residential construction, non-mining business investment, and government infrastructure spending. And this chart shows you how those three categories have shifted over the last few years. Well, the residential construction side's worked really well. We've had a major boom, very good at generating economic activity and jobs. The other components, though, have been a bit more disappointing. We've seen a pretty flat picture for non-mining capex, and we've seen an extremely weak picture for the green line there, which is government infrastructure spending. What that chart is actually telling you is that government capex today is 30% lower than it was in 2012 at the height of this mining boom. So rather than helping the transition, it's actually been a significant drag. What needs to happen here? Well, I think two things. What stands out from our experience is we think many companies have what look like unrealistically high hurdle rates of return. The surveys tell you most companies want something like 10 to 15% of rate of return before a project will get the go-ahead. That does look very high in a low yield, low return, low inflation environment. Governments, well, clearly they need to do more on that front, and most economists would agree that it's not necessarily about selling existing assets to pay for new infrastructure. We should be out there borrowing as well. Governments can borrow pretty much as they want at 2.5% for 10-year money at the moment. It'd be extraordinary if there's not a whole list of projects that we could find that are going to pay better than a 2.5% rate of return. So clearly, these are the sort of issues that we do need to work on if we're going to keep the positives running in Australia. And just finally, I just wanted to say a couple of things about the medium term. Not surprisingly, we're all very focused on the short term, but there are some medium term opportunities building out there that offer plenty of opportunities, we think, for the Australian economy. And one interesting way of illustrating that was this chart here that I came across, based on some work by McKinsey's. And what they've done is that they've calculated where the centre of economic gravity is over the last 2,000 years or so. And what you see is a pretty inexorable shift to the west, if you like, as Europe emerged, Industrial Revolution, UK, followed up by the US as well, until we get to the 1960s, where that move to the west came to an end, and we started shifting back east as Japan first emerged, and then of course China and the rest of Asia. But the point I want to make about that chart is just how fast that transition back towards the east is taking, or is running. It took 2,000 years to get all the way to the west. And on those sort of figures, it's going to take about 50 years to get back to where we started from. So what it means from an Australian point of view, of course, is the centre of economic gravity is shifting back towards us. So there's going to be opportunities there, particularly when you look at what's driving that shift, and what it is rising income growth. Incomes in the Asian region are expanding quite quickly. The number of middle-income consumers is growing at a very rapid rate. We know from experience that income is going to be spent in certain areas. It's going to be spent on food, more of it in better quality. It's going to be spent on bigger and more elaborate dwellings. Bigger apartments are going to need more still to hold them up, so I'm positive for that part of the story. People want access to education, and like everybody else, they like to go on holidays. And just finally, sort of one example of where the benefits are there, and in fact how we can already start to see them. Well, the clear one there, I think, is tourism. This chart on the left-hand side, it shows you where tourists to Australia come from, and the rapid growth from China obviously is the standout there. In the last 12 months, something like 1.2 million people from China have been to Australia for a holiday, huge number. And of course, the good news is there's at least 1 billion who haven't been to Australia yet, so it gives you an idea of the growth potential. But what we've also discovered is that Chinese tourists spend more than any other tourist when they're here. You can see that on the chart on the right-hand side, and particularly in the retail part of the economy. So I think it gives you an indication of some of the potential that lies there for a range of sectors in this Asian income story, and plenty of opportunities there for the non-resource part, the non-mining part of the Australian economy, just as there were for the resources sector in the early part of this process. Now, I'll stop at that point. I will show you my 3-page disclaimer though, just to cover off on that one. And thank you very much for your time today.